Most people think gold moves because of fear. That is too simple. Fear is what the crowd feels after the move has already started. Fear is the noise in the hallway. I care about the beam that cracked in the ceiling before the noise began. If you own dollars, stocks, bonds, retirement accounts, rental property, or a house whose value is measured in dollars, you are living inside one monetary house, whether you admit it or not. Most people spend their lives decorating that house. They argue about paint colors, they compare one room to another, they complain that the view used to be better. Very few stop to ask whether the load-bearing structure underneath the entire place is being quietly altered while they sleep. That is where the real money is made, not in reacting to the headline after everyone else has already read it, not in chasing the chart after the move has already embarrassed the skeptics, not in telling yourself that gold is just an inflation trade or just a fear trade or just a barbarous relic when it is boring, and suddenly a sacred asset when it is soaring. I have watched markets long enough to know that when people reach for simple explanations, it usually means they are standing on top of something they do not understand. The change that matters most is almost never loud at first. It is procedural, it is technical, it is dressed in the language of stability. It is introduced with terms that sound harmless enough to put you to sleep. Then one day the crowd wakes up and discovers that the house they thought was permanent has different walls, different stress points, and a different owner than they imagined. That is where we are now. The Federal Reserve did not merely make a policy adjustment. It did not simply massage a rate expectation or change the mood of a press conference. It reached into the monetary architecture and quietly began replacing a beam the public had been told was still solid. And the reason that matters for gold is not mystical. It is arithmetic. When arithmetic corners a central bank, gold stops behaving like a commodity and starts behaving like a witness. I want you to understand that sentence because it is the sentence most investors are going to learn too late. Gold is not making an argument. Gold is recording one. The average investor looks at a gold chart and asks whether the metal is overbought, whether yields are too high, whether the dollar is too strong, whether this month is favorable seasonally, whether a television personality sounds bullish enough to justify owning it. I have never found much edge in that way of thinking. I would rather ask a harder question. What has changed in the architecture of money that the market is starting to price before the public has found the language for it? That is the question that separates the man who is renting his opinions from the man who actually owns his convictions. There are several mechanisms inside this story, and if you do not name them properly, you will not survive them properly. The first mechanism is what I call the facade language. When institutions need to do something extraordinary, they almost never announce it in words ordinary people would use. They do not say, "We have painted ourselves into a corner, and we now have to create more money to keep the debt machine from choking on its own weight." They say reserve management, they say liquidity support, they say market functioning, they say temporary operations, they say technical adjustment. That is not communication. That is architecture covered with wallpaper. I am not offended by that. I expect it. When you run a monetary system, you learn very quickly that language is part of the plumbing. But as an investor, you had better learn to strip the wallpaper off with your bare hands. If new money is created to buy government debt that is not made safer by a careful choice of nouns, the mechanism remains the mechanism. And once you see the mechanism, you stop debating tone and start following consequence. For years, the public was told a story of tightening discipline, inflation fighting, balance sheet reduction, and moral seriousness. Then the debt math became too heavy to carry elegantly, and the same institution that had been lecturing the public about restraint began finding reasons to lubricate the system again. Not because discipline suddenly became fashionable in reverse, not because the inflation problem was solved forever, not because a central banker woke up and felt sentimental, because the load on the beam became too great. That brings me to the second mechanism, the refinancing wall. People throw around large debt numbers because large debt numbers sound frightening. I do not care whether a number is frightening. I care whether it creates a machine that forces behavior. A debt problem becomes real when it stops being a statistic and becomes a schedule. The United States is not dealing with debt as an abstract future issue. It is dealing with debt as a rolling wall of obligations that must be refinanced, repriced, absorbed, and serviced in real time. Trillions do not sit there politely. They mature, they demand rollover, they return to market, they ask one brutal question over and over: at what price can this system continue? If rates are low, the currency takes the insult. If rates are high, the interest bill takes the insult. If the market will not absorb the debt naturally, the central bank is dragged toward the table whether it wants to come or not. That is not ideology. That is engineering. And when you understand that, you start to see why the public argument is often so silly. People still talk as if policymakers are choosing from a menu. They are not choosing between perfect options. They are negotiating with constraints. They are choosing which section of the house gets damaged first. If you tell me the interest cost on the national debt is surging, if you tell me vast amounts of debt must be refinanced at rates far above the old zero-rate world, if you tell me private demand for that paper is thinner than it used to be, and if you tell me the central bank is already inching back toward purchases dressed up in softer language, then I do not need a slogan. I already know what room of the house is under stress, and when that room is under stress, gold does not need permission to matter. The third mechanism is the force printer. There is a world of difference between a central bank that prints by preference and a central bank that prints by compulsion. The first still looks like a pilot. The second looks like a passenger grabbing the controls after the cockpit door has already come off. Markets eventually price that difference. A central bank that chooses accommodation can still maintain the illusion that it is acting from strength. A central bank that is pushed into accommodation because the bond market, the banking system, and the debt service burden leave no clean alternative has crossed an invisible line. On one side of that line, policy is a tool. On the other side, policy is a confession. The public almost never notices the line when it is crossed. They notice later when asset prices begin moving in ways that feel irrational if you still believe the old architecture is intact. They ask why gold is rising while officials sound calm. They ask why hard assets behave as if they distrust the words being spoken on television. They ask why there seems to be a growing premium on things that cannot be printed, diluted, sanctioned, or politically redefined. The answer is not hidden. The answer is simply unpleasant. Confidence in a currency regime does not disappear all at once. It leaks first among the people paid to read balance sheets and reserve flows for a living. It leaks in central banks. It leaks in sovereign funds. It leaks in the behavior of nations that do not want to wake up one day and discover their reserves are neutral only until they become inconvenient to someone more powerful. That is one reason gold has been accumulated by official buyers so aggressively in recent years. Nations may smile publicly while quietly rearranging their reserve furniture at night. They do not need to make dramatic speeches to tell you what they believe. They show you in tonnage. And once enough serious players begin moving the same way, it is wise to ask whether they are paranoid or simply early. I have learned something about early in markets. Early always looks lonely right up until it looks obvious. The fourth mechanism is the sanction memory. Most investors think reserves are reserves. That is the sort of statement a person makes before history teaches him the difference between possession and access. When a sovereign nation sees another sovereign nation's reserves frozen with a keystroke, a permanent scar is left on the imagination of every policymaker who is not protected by ironclad alliance. They may not hold a press conference. They may not shout about de-dollarization every week. They may still use the existing system heavily. But a memory has entered the room, and memory changes architecture. If an asset can be blocked by policy, it is not the same thing as an asset you can hold in physical form without relying on your rival's legal mood. That does not mean the dollar disappears tomorrow. People who think in cartoons always jump to the final scene. I do not. The dollar can remain dominant and still become less trusted at the margin. The dollar can remain central and still inspire a long, quiet migration into alternative reserve behavior. The dollar can remain the biggest room in the house and still no longer feel like the only room safe enough to sleep in. That is how great transitions usually happen. Not with a theatrical collapse first, with a slow reallocation of trust. And gold has one advantage in that world that paper promises cannot imitate. It does not require another nation's signature to remain what it is. That is a sentence central bankers understand instinctively. Retail investors tend to understand it only after the premium has already been paid. The fifth mechanism is the oil accelerant. I have seen many investors underestimate the role energy plays in compressing time. Without an accelerant, a monetary story can take years to become visible. The debt arithmetic worsens quietly. Reserve flows shift gradually. Confidence thins at the margin. Gold climbs and people call it mysterious. Then energy shocks enter the frame, and what could have been a slow leak becomes a pressure event. Oil does not merely affect gasoline prices and transportation costs. Oil moves through the economy like a stain through fabric. It embeds itself in food, freight, manufacturing, margins, household budgets, politics, and inflation expectations. And it does something else that is even more dangerous for policymakers. It raises inflation while simultaneously making tight money harder to maintain. That combination is poison for monetary credibility. If you tighten aggressively into an energy shock, you increase the risk of snapping already stressed borrowers, markets, and governments. If you do not tighten enough, the inflation stain spreads and the currency pays. Either way, the burden on the architecture intensifies. This is why major oil disruptions have so often coincided with powerful moves in gold. Not because gold and oil are romantic cousins in a commodity family, because oil shocks expose how little room for elegant policy making is left inside a leveraged monetary system. An oil shock turns debate into timetable. It tells you whether the house has spare beams left or whether everything is already leaning on the same two. When geopolitical disruption threatens energy flows, when crude stays elevated, when importers need more dollars at the exact moment, dollars are becoming more expensive and harder to source, forced behavior begins to appear all over the system. That behavior does not remain local for long. A nation defending its currency is not acting from philosophical conviction. It is meeting a bill. A central bank selling gold into that stress is not making a civilizational statement against the metal. It is feeding the fire extinguisher because the hallway is smoking. That distinction matters enormously. One of the great mistakes in markets is failing to distinguish between forced selling and changed belief. If a man sells his best farmland because the bank gives him no choice, you must not conclude he has lost respect for farmland. You must conclude he needs cash more urgently than he can defend principle. Markets repeatedly confuse those two states. That confusion creates some of the best opportunities an investor will ever see. When gold is sold because sovereign balance sheets, war financing, energy stress, or currency defense create temporary dollar hunger. The weak mind says the bull story is broken. The strong mind asks a better question. Has the strategic logic actually changed, or has a participant simply been forced to liquidate while the underlying reason for owning the asset remains intact? If the logic remains intact, then the liquidation is a reset, not a verdict. That is the sixth mechanism, the reset floor. I have seen this pattern before. A trend becomes crowded enough that people begin to think nothing can interrupt it. Then stress appears in a part of the system most onlookers never considered. Highly motivated holders become involuntary sellers. Price falls, retail conviction evaporates. Commentators declare the thesis dead because commentators are paid to mistake movement for meaning. Then, when the forced selling exhausts itself, the asset re-anchors around the strategic reality that existed before the liquidation began. In plain English, the floor is built by exhausted necessity. That is often where fortunes are made, not when the story is beloved. Not when magazine covers flatter your intelligence, when someone stronger than you wanted to keep an asset but had to sell it anyway. That is the moment price and truth diverge. It is also the moment most people cannot act, because their psychology still belongs to phase one thinking. They mistake downward pressure for permanent invalidation, because they do not understand the architecture that created the selling in the first place. Now let me tell you the identity shift that matters here, because this is where most investors either grow up or remain children forever. You must stop being a price watcher and become an architecture reader. A price watcher lives on the surface of the house. He reacts to every creak. He thinks the market is speaking directly to him through candles, headlines, and narratives that change every 48 hours. He has no framework larger than the last move. So when gold falls, he says the story is over. When gold rises, he says he may be too late. When miners lag, he says the thesis must be broken. When policymakers sound confident, he says perhaps the danger was exaggerated. He is not investing. He is renting emotional shelter from the crowd. An architecture reader is different. He asks what reserves are doing. He asks what refinancing needs are doing. He asks what energy shocks are doing to the menu of policy choices. He asks whether central bank balance sheet behavior is voluntary or coerced. He asks whether official buyers are changing strategy or merely navigating a crisis. He asks whether an apparent contradiction in asset pricing is actually the market pricing, a structural shift before the public has language for it. That man can sit still while others become dizzy. That is one of the highest forms of financial power I know. Not brilliance, not prediction. Stability earned through better framing. Most people want a portfolio that feels exciting. I have always preferred one that lets me think clearly, while other people lose their minds. That is why, when the monetary architecture changes, I do not ask how to feel. I ask how to build. If you want something concrete, I will give it to you. I use what I would call a 3-room protocol inside one house. The first room is liquidity. If the architecture is under stress, I do not want all my optionality buried under leverage, long-duration promises, or forced timetables. Cash has flaws. Cash can be diluted. Cash can underperform, but liquidity gives you something more valuable in a crisis than a heroic spreadsheet. It gives you the ability to move when others are pinned under their own good intentions. The second room is monetary insurance. This is where gold earns its place. Not because I expect civilization to end on Tuesday morning. Not because I worship metals. Not because I think every line on a chart is destiny. Gold belongs in the house because it sits outside the promise structure of paper money. It is what I want nearby. When confidence in the promises gets thinner than the officials admit. It is not there to entertain me. It is there to keep one part of my house from depending entirely on everyone else's honesty, competence, and solvency. The third room is productive ownership. I still want businesses. I still want cash flows. I still want assets that can price, adapt, and compound. But in an architecture shift, I become more selective about the kind of business I own. I want real pricing power. I want balance, sheet resilience. I want necessities, not fantasies. I want companies that can still collect from customers when financing is more expensive and confidence is scarcer. This is the part younger investors often miss. When the house is under stress, I do not abandon business ownership. I become stricter about what counts as a business worth owning. A glamorous story financed by cheap money is not a durable business. A capital-intensive operation with poor balance. Sheet discipline is not a durable business. A company whose prosperity depends on permanent financial euphoria is not a durable business. I want the dull things that survive. I want the boring things people keep paying for. I want the cash flow that does not need applause. That is how you stay rich, while other people are trying to get rich quickly. Now let me say something about gold miners, because this is another place where architecture reading matters more than price watching. When the gold price rises meaningfully, the economics of a miner can change much faster than the economics of the metal itself. A business that was scraping by on thin margins can suddenly see its free cash flow transform when realized prices lift while its cost base lags. That embedded operating leverage can create extraordinary upside, but you must remember what you are owning. A miner is not gold. A miner is a business with operational risk, jurisdiction risk, management risk, reserve risk, financing risk, and human foolishness layered on top of metal exposure. So I do not treat miners as a substitute for monetary insurance. I treat them as leveraged productive exposure where due diligence matters enormously. If you do not understand that distinction, the same architecture that protects you can seduce you into taking risks you cannot explain. That is how a good idea turns into a bad portfolio. You do not need every instrument. You need clarity about the role each instrument plays. When people confuse insurance with speculation, or liquidity with cowardice, or patience with passivity, they walk into markets carrying the wrong tool for the wrong room. Then they wonder why the repairs fail. There is another trap here that I want to drag into the light. Many people assume that if the Federal Reserve has not yet admitted weakness in language dramatic enough for a newspaper headline, then the architecture cannot be shifting in a serious way. That is, childish institutions rarely describe turning points with the precision investors wish they would. They leak them in operations, contradictions, accounting choices, and behavior. By the time the statement becomes plain, the easy part of the move is often over. Certainty has terrible timing. The crowd says it wants certainty. What it really wants is permission to act without feeling brave. Markets do not usually pay well for that preference. The men who bought insurance before the fire alarm was audible always look paranoid in the quiet phase. The men who wait for smoke to enter the room always call themselves prudent. Then the bill arrives. I am not telling you phase 3 arrives tomorrow. I do not need melodrama to make a serious point. But I have seen enough cycles to know the shape of escalation when I see the early beams moving. First, the institutions reposition quietly, Then the market begins to suspect that policy is constrained rather than sovereign. Then inflationary or geopolitical accelerants compress the timetable. Then the public moves emotionally into the story at the worst possible prices. Then commentators explain with great confidence why what happened was always obvious. That is how almost every major transition gets narrated after the money has already been made. I have no interest in paying premium prices for hindsight. So here is the choice I would put in front of you. You can continue living in the decorative layer of the monetary house, arguing about whether the last move in gold was too emotional, whether the latest policy phrase sounded hawkish enough, whether the crowd on social media is too bullish, whether the chart looks tired, whether the old assumptions about debt, reserves, and credibility still deserve your loyalty simply because they are familiar. Or you can step down into the basement and look at the beams. You can ask what happens when a debt-heavy government must refinance trillions at rates that punish yesterday's assumptions. You can ask what happens when a central bank that preached restraint begins lubricating the very market it insisted could stand on its own. You can ask what happens when energy shocks reduce policy flexibility at the exact moment fiscal arithmetic is already demanding accommodation. You can ask what happens when sovereign actors remember that paper reserves can be frozen and physical gold cannot. You can ask what happens when forced liquidations create temporary price weakness in an asset whose strategic logic has not actually been damaged. And you can ask the most important question of all, do I want to be the man who understands the architecture while the price still looks arguable, or the man who waits until the explanation is on every screen and the opportunity has become expensive? That is the mirror. There is no neutral answer. If you do nothing, you are not preserving innocence. You are signing the old blueprint and hoping the stress fractures are cosmetic. If you prepare intelligently, you are not becoming alarmist. You are refusing to let public language substitute for private thought. I have spent a lifetime learning that the real risk is rarely the thing people yell about first. The real risk is the thing respectable people minimize until the math becomes too public to hide. And by then, the repricing is usually well underway. Gold does not need your enthusiasm. It does not need your ideology. It does not need you to join a tribe. It only needs a world in which too much debt, too much refinancing pressure, too much geopolitical distrust, and too little monetary freedom are all leaning on the same architectural beam. That world is not coming. It is already here. The only question is whether you still insist on judging the house by the wallpaper. If I were sitting across from you and I had to reduce everything I have said to one final sentence, it would be this. Do not wait for the house to shake hard enough for the crowd to notice before you decide what kind of structure you want to live in. By then, you will not be choosing from strength. You will be choosing from fear. And fear is where people pay the highest prices for the assets they refuse to understand when they were merely early.